Okay, so now we turn our attention to the final reading in structured products, which is the equity linked structured products section. So here we're more looking at structured products that allow us to change the payoff profile of an investment, or to change the tax status or the nature, income for capital gains, that sort of thing, rather than with things like CDOs, CMOs. Yes, there was changes in risk profile, but the primary driver really was accessing some illiquid private collateral. Here it's more about not necessarily accessing the collateral, but changing the nature of the payoffs from the collateral. So one of the major kind of wrappers that you could put around a structured product, or one of the reasons for structuring a product, might be to change the tax status of the cash flows, change it from income which is taxed periodically to capital gains which can be deferred, for example. So we do need to know about the different tax effects of different types of wrappers. There's 4 here. A structure, a product, could be tax-free, could be fully taxed. Those two are relatively trivial. Or you could have a structure where tax is deferred to the end of the period. So that's a bit like deferred capital gains. That's tax effect number 3. And then there's number 4 here, which is where we defer taxation completely to the end of the period, and we then deduct all taxes at the end. So these ones 3 and 4 are not trivial, but we'll look at this example to demonstrate how they work. An investor's got a time horizon of 10 years, so that's your that's your N, if you like, your number of years. The pre-tax return in the account is 5%, so that's what we earn prior to any taxes. What is the after-tax rate of return under the following tax wrappers? Okay, so the first one is trivial, isn't it? If there's no taxes, our after-tax return is the same as the pre-tax return, which is 5%. So that's great. The fully taxed scenario, that's scenario number 1. The fully taxed scenario should be trivial. You should just kind of say, well, 5% times 1 minus the tax rate is your post-tax return if you're taxed every period, if you're fully taxed. However, the way that the curriculum presents this is just, they just try and make it a little bit less straightforward. 75% of your return is income, taxed at 30%, and the remaining 25% is capital gains, taxed at 40%. So you've just got to break your returns up into those components. 75% of the pre-tax return is income, and that is taxed at 30%. So your post-tax return from income sources is 2.625%. Post-tax capital gain return will be the 5% multiplied by 0.25, because 25% of your return is capital gains. That's taxed at 40% of the income tax rate. So read it carefully. I might have just said 40% there, and that's a good demonstration of how you've got to read things carefully. Okay, so capital gains tax is taxed at 40% of the income tax rate. Right, so call it what it is. 40% of the income tax rate is 12%, isn't it? 40% of 30%, 0.4 times 30 is 12%. However, just be careful with that. Where that's what comes through here. If you multiply them together, 40% of the income tax rate of 30% is 0.12, which is the 12% that the capital gains tax rate must be. So yeah, they're just trying to present it in a way such that you can slip up if you try and read it too quickly, as I just demonstrated there perfectly for you. So be careful with that. All right, so 5% of your pre-tax return, 5% is your pre-tax return. A quarter of that is capital gains, and that's taxed at 12% essentially. So you're left with 1.1% there. Bolt those two together, and you've got your total post-tax return. All right, so a little bit more fiddly than it might first appear there. But that's the second method. The other two methods, tax deferral, that's essentially like deferred CGT, like deferring all your taxes